Technical questions, breaking into investment banking. This is lesson 3 of class 3. In this lesson, we will review the best practices for answering technical questions, the most common and most important technical questions, and other potential technicals that candidates should be aware of during the interview process. Background. The Warren Fox Group defines technical questions as any interview question that evaluates the candidate's comprehension of finance, accounting, or economics. Most investment banks will designate at least one interview as a technical interview in which only technical questions will be asked. Technical interviews are usually structured around 3 main questions, and then depending on how the candidate answers those questions, the interviewer will continue with adjacent questions that increase in difficulty and granularity. Question breakdown. Mandatory questions. Questions that appear in nearly every investment banking interview process. Adjacent questions. Questions that follow on to the mandatory technicals and test a deeper understanding of the subject. And then there's supplemental. These questions might come up throughout the interview process and are usually specific to certain roles. The first two, mandatory and adjacent, are your core technical questions. And then the supplemental questions are your non-core technicals. Mandatory technical questions. The Warren Fox Group highlights the below questions as mandatory questions that candidates should expect on interview day. Walk me through a discounted cash flow model. Describe the 3 financial statements and how they are each connected. What are the 3 main types of valuation analysis? Assuming the candidate answers each mandatory question correctly, the interviewer will continue to ask deeper and more granular questions about the topic. During this video, we will review these questions at a very high level. A more in-depth review of questions and answers can be sourced at our website, www.thewarrenfoxgroup.org. Walk me through a DCF. The candidate will utilize or develop a projection model for the company. The candidate will then walk down the income statement from revenue to net income. Once at net income, the candidate will transition to the cash flow statement. The candidate will adjust net income for cash and non-cash items such as depreciation, changes in working capital, and capital expenditures. The candidate will calculate near-term free cash flows and then calculate a terminal value. Once these values are determined, the candidate will apply a discount rate to return the present value of the target company. So some common adjacent questions that might follow. What are the different methods of calculating terminal value? What is the difference between levered free cash flow and unlevered free cash flow? What does the discount rate represent? How do you use the discount rate? And what do you use the discount rate? How do you calculate WACC? How do you calculate the cost of equity? What does beta represent and how do you calculate it? How do you calculate the cost of debt? How are the 3 financial statements connected? So depending on how deep the candidate wants to dive into each financial statement, this could get really long and complicated. The best advice here is to keep it simple and to allow the interviewer to dive deeper into each area as they see fit. How to best handle this question? List the 3 financial statements, provide a brief description on each, and then walk through them while concurrently describing how they are each connected. For example, the candidate will list and define the income statement, cash flow statement, and balance sheet. From there, the candidate will walk through each statement starting with top-line revenue, therefore beginning at the income statement. Ultimately, the candidate needs to walk the interviewer from revenue to free cash flow, and then describe the additional adjustments needed to arrive at a cash position. Then speak about the balance sheet and how the cash balance moves from year to year, while ensuring equality on the balance sheet. Assets equal liability plus equities. As the conversation moves from revenue to free cash flow to ending and beginning cash amounts, the candidate will effectively describe the statements and how sufficiently tie each statement together. Financial statement analysis continued. The 3 financial statements include the income statement, which is a financial document that records the company's revenues and expenses, including both cash and non-cash items. Cash flow statement is a financial document that adjusts net income for cash and non-cash items to show the company's true cash position. And then the balance sheet, a snapshot in time of the company's current financial position from the perspective of asset, liabilities, and equity. So some common adjacent questions might include, what is working capital? How is it calculated? Do you include cash? Why or why not? What is a working capital peg, and how does it relate to the purchase price? What would happen to net income and cash if depreciation increased by X amount? What are deferred tax assets, deferred tax liabilities, and how does each affect the financial statements? What happens to cash when a company increases inventory? What is an opening and closing balance sheet? What are the differences? What are the 3 main types of valuation analysis? This is the 3rd mandatory technical question. So an abbreviated answer might include, there are many forms of valuation. But in finance, the most common forms of valuation are done through two methodologies, the absolute method and the relative method. The absolute method utilizes a discounted cash flow analysis, and the relative method utilizes the guideline public comparable analysis and the recent transaction analysis. So analysis 1, DCF, measures a company's intrinsic value by determining the present value of its future cash flows, driven by the company's projection model, taking into account company-specific attributes, such as revenue growth, profit margins, available free cash flow, and risk profile. The main caveat to a DCF is that a company theoretically needs to be cash flow positive, or at least have a direct path to profitability in the near term. Analysis 2, GPCs, measures the company's relative value by viewing the current pricing of similar assets in public markets. Apply current market multiples to the company's revenue or EBITDA figures to yield a relative value. Analysis 3, precedent transactions, measures a company's relative value by viewing similar assets that recently traded in the marketplace. Apply current recent trading multiples to the target company's revenue or EBITDA to yield a relative value. So valuation analysis continued. So some common adjacent questions might include: name some pricing discounts or premiums that could further affect valuation, such as an illiquidity discount or a country risk premium. What is a football field valuation chart? How do you calculate enterprise value? What does TTM stand for? How do you calculate TTM? What does PE ratio mean, and why is it important? How is PE ratio different than enterprise value over EBITDA? What does PE ratio not take into account? So then finally, some supplemental technical questions. In addition to the core technical questions, mandatory and adjacent questions, the interviewer might ask supplemental questions dependent on the role or the seniority level of the position. Below are some examples. How can two companies with the same exact earnings in the same industry have different PE multiples? Can a company have a negative enterprise value? Can a company have a negative equity value? For private companies, can bankers utilize WACC as a discount rate? How is market capitalization different than the equity value on a balance sheet? If you had $10 million of capital, how would you invest it? What is meant by accretion and dilution? And how can you tell if a deal is going to be immediately accretive versus immediately dilutive? What are the two types of synergies? Which one is easier to calculate and more reliable from a modeling standpoint? Thank you for tuning into this lesson, and we look forward to seeing you at our next lesson, in which we will cover case study exercises.